We got the first of the credit card master trust data yesterday afternoon, and that was from Discover. Obviously that name is of particular interest to us together with Capital One because these are card lenders that have disproportionate exposure to sort of the subprime and kind of lower rung of consumers and borrowers. And so if we just pull up this kind of 30-day delinquency table that we like to look at and sort of profiles the different 7 major issuers, I think that's on slide 21. The bottom half of that table, we show the year-over-year change in the 30-day delinquency rate. And as Josh mentioned this morning, looking at it sequentially, looking at changes in the level sequentially is not really a worthwhile exercise because the data is very seasonal. But if we look at that bottom part of that chart, we see the year-over-year change in the 30-day delinquency rate. And the color of the text, if it's red, indicates kind of the sign of the first derivative, right? So if it's red, it's negative. These delinquency rates are getting worse on a year-over-year basis. And then as the shading is kind of meant to sort of the second derivative overlay, and as it gets more red, that means that the first derivative is either is decelerating or deteriorating. So we've basically seen credit, sort of hyper-normalize and really deteriorate at an accelerating rate. And just to kind of contextualize that, how we've been really thinking about that is through the kind of lenses of these 2 different effects. One we call the inflation effect, which is this sort of slow regressive tax that is sort of cumulative in nature, unlike, let's say, an unemployment shock, which is very acute and immediate. We think that's really been driving, this deterioration in credit, particularly among that kind of lower rung of consumers. And that effect has been interacting with this other effect, which is we call sort of the catch-up effect or the reverse sort of survivorship effect. And that simply states that periods of credit outperformance tend to beget periods of subsequent credit underperformance, and vice versa, right? An example is the Great Financial Crisis. That pulled forward a lot of bad credit, a lot of credit underperformance, and then subsequently we had sort of a longer period of credit outperformance. Conversely, the pandemic really represented, the kind of mother of all bailouts for that, most fragile segment of the consumer. And now we're on the other side of that. We're on the other side of the credit outperformance associated with that mother of all bailouts. And accordingly, we're seeing, 30-day delinquency rates at the likes of Discover and Capital One really shoot up.
Don't forget that our projections for the U.S. economy are far worse than the Fed's and of Wall Street's. Wall Street thinks that we have Goldilocks. They think that because the stock market went up, that they're going to get their bonus and they're not going to have a recession. Well, that's a very small percentage of the population. That's not the cycle. What Drago just showed you are the people, right? And by the way, the Fed has not cut rates yet. So it's not like you go to pay off your credit card, Drago, after the holidays and you got a rate cut on that, right? I mean, I'm pretty sure you're going to still have the same APR.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.